Today, we're diving into a seismic shift in global finance that most people aren't paying attention to yet, but they should be. We're talking about Japan making moves that could reshape American borrowing, Wall Street's next crisis, currency markets in absolute chaos, and why your mortgage rate just keeps climbing. And believe me, I've saved the most eye-opening piece for the very end of this episode. I spent years inside one of those big polished media organizations, the kind where every story had to fit neatly into the approved narrative. I watched how inconvenient facts got smoothed over, how complexity got dumbed down, and how the truth often took a back seat to what kept advertisers happy. I couldn't do it anymore, so I left. Now I'm on my own, I answer to no one, and I tell you exactly what's happening. No spin, no corporate agenda. And listen, if you find value in what we do here, I need to ask you something. Hit that like button, subscribe to this channel, and if you can, please consider becoming a sponsor. We spend hours fact-checking every claim, cross-referencing sources, making sure we're not feeding you fake news or sensationalist garbage. That takes time, that takes effort, and frankly, it takes resources. Your support keeps this independent operation running. And one more thing, stick with me until the end, because what I'm going to reveal in the final minutes ties all of this together in a way that'll change how you see the entire global financial system. So let's get into it. Recently, we've been seeing these absolutely sensationalist videos popping up all over YouTube, screaming about Japan and some supposed apocalypse in the US bond market. And look, I get it. Drama sells. But today, let's take a breath, step back from the hysteria, and actually understand what's happening. Because what Japan is doing right now, it's not just some isolated policy decision. This is a genuine earthquake rippling through global markets. And yes, it's rattling Wall Street, it's spooking currency traders, and it's raising some very urgent questions about America's ability to keep borrowing like there's no tomorrow. It all started when Japan's government rolled out this massive multi-billion-dollar stimulus package. Now, analysts immediately warned that this wasn't just a domestic issue. This thing could undermine Japan's financial stability, sure, but here's the kicker. It could also destabilize the United States economy. The backlash came fast. The yen, Japan's currency, it tumbled to levels we haven't seen in nearly a year. Japanese finance officials started issuing these verbal warnings, signaling they might intervene to prop up their sinking currency. Japan's finance minister, Satsuki Katayama, she came out and cautioned that Tokyo might have to step in to counter what she called volatile and speculative market moves. The yen jumped briefly after that statement. But here's the thing, that little bounce, it did almost nothing to change the big picture. And the big picture is this. The yen is weak, markets are incredibly nervous, and Japan's fiscal situation isn't just a problem for Tokyo anymore. It's spiraling into a global crisis. Some economists, Peter Schiff among them, have gone as far as warning that Japan could inadvertently torpedo the US economy. And when you look at the numbers, it's really hard to dismiss those warnings. The yen has already lost around 6% of its value since Prime Minister Shigeru Ishiba came into power. That decline, it's being driven by aggressive spending policies. Japan's fiscal outlook is deteriorating rapidly, and at the same time, there's immense pressure on the Bank of Japan to maintain ultra-loose monetary policy. So you've got more spending, more debt, but no tightening in sight. That's a dangerous mismatch. But here's where it gets even more intriguing. The result of all this is something we don't see very often. And when we do, it's usually a very bad sign. Japanese government bonds and the yen are falling at the same time. That pattern, historically, it signals two things. Capital flight, meaning investors are getting their money out of Japan as fast as they can. And deep market distrust, meaning nobody believes Japan can fix this mess. Some analysts are even drawing comparisons to the UK's 2022 bond meltdown. Remember that chaos? Unfunded tax cuts triggered absolute mayhem in the gilts market. But Japan's situation has an added twist, and this is crucial. Its choices carry far heavier global consequences than the UK ever could. Now, before we go any further, let me remind you, if you're finding this valuable, drop a comment below. Let me know what you think about these developments. Are you worried? Are you prepared? I want to hear from you. And if you haven't subscribed yet, do it now, because we're just getting started, and what's coming next is going to blow your mind. Here's the most troubling part of this entire story, and this is where it really hits home for Americans. For decades, Japan has been America's financial anchor. Japan has been buying more US Treasury debt than any other country in the world. At its peak, Japan held $1.2 trillion in US bonds. Think about that for a second. That's trillion with a T. Effectively, Japan was subsidizing America's spending habits, keeping US mortgage rates low, keeping credit rates manageable, but those days, they're ending. They're gone. As yields on Japanese bonds have surged to their highest levels in decades, 20-year yields are hitting levels we haven't seen since the 1990s. 30-year yields broke above 3.3%. Japanese investors suddenly have very good reasons to keep their money at home. And this is exactly what the United States does not want. So here's the trillion-dollar question, literally. Who's going to finance America's out-of-control government spending now? The math that made Japan the world's biggest lender to America, it simply doesn't work anymore. Rising yields domestically in Japan mean higher returns for Japanese investors at home. Japan has an aging population that needs its savings to stay close. New regulations are pushing major Japanese insurers to buy more domestic ultra-long bonds. In the third quarter alone, Japanese investors sold nearly $62 billion in US treasuries. Now, some people want to spin this as diversification, just portfolio rebalancing. Don't believe it. That's an exit. That's capital fleeing US debt. And Wall Street? They're finally waking up to this reality. Analysts at Citi, for example, they've warned that this shift could trigger what they're calling a global market Armageddon. Charles Schwab recently cautioned that the repatriation of Japanese capital, money flowing back to Japan, could push US yields even higher. Market veterans are saying this marks the end of an era, the end of America's 4-decade run of cheap borrowing that was subsidized by foreign buyers, primarily Japan. And here's the part that should really get your attention. You're already feeling the effects of this shift, whether you realize it or not. Mortgage rates that were sitting near 2.6% during the pandemic, where are they now? They're hovering close to 7%. Credit card rates are at record highs. Car loan rates are climbing. And as Japanese investors step back from US treasuries, the buyers who remain, they're demanding higher yields. That raises borrowing costs for everyone, corporations, consumers, and yes, the US government itself. This is the uncomfortable reality that nobody in Washington wants to confront. Japan's retreat from US debt isn't some temporary blip. This isn't a couple of bad months that'll sort themselves out. This is structural. This is permanent. The country is aging rapidly. It's drowning in debt worth 235% of its GDP. Just wrap your head around that number. Its bond market is breaking under the weight of endless stimulus, and its new prime minister is locked in an escalating economic and geopolitical confrontation with China. From tourism boycotts to seafood bans to military pressure, everything is on the table. Domestically, Japan needs money for defense spending, for more stimulus, for currency support operations, and for mounting debt service costs. But here's the problem. Recent Japanese bond auctions have disappointed. The government has fewer options than ever. If Japan raises interest rates to strengthen the yen, its debt costs explode. If it doesn't raise rates, the yen keeps collapsing. Either path accelerates the unraveling of a system that once seemed rock solid and permanent. But what most people miss is the next layer. And then there's the carry trade. Now, if you're not familiar, the carry trade is this global financial machine built on borrowing cheap yen to buy higher-yielding assets elsewhere. When the yen is stable, the carry trade fuels everything: US stocks, emerging market bonds, all kinds of speculative positions. But when Japan's monetary world begins to wobble, when things start to tumble, that entire trade can unwind in a matter of days. We saw glimpses of this last year, when the S&P 500 dropped 3% in a single day after a brief yen surge. With Japan now losing control of bond yields and currency stability, the risk of a violent carry trade reversal is rising again. And if that happens, we're not talking about a gentle correction. We're talking about a violent, chaotic market event. So what happens next? What should you be thinking about? Americans need to prepare for a world where money is no longer cheap. Locking in fixed-rate debt becomes absolutely essential because adjustable rate loans are going to climb as Treasury yields rise. There's no way around it. Analysts at BlackRock and Morgan Stanley are now recommending that investors add variety to their portfolios: real estate investment trusts, gold, commodities, alternative strategies. Volatility is going to become the norm, not the exception. This isn't transitory. This isn't some temporary phase we're going through. Japan's fiscal crisis isn't just a story about another country's budget problems. This is a genuine turning point in global finance. This is an inflection moment where the world's most reliable foreign creditor steps back, forcing the United States to compete for global capital at the worst possible time. We've got massive deficits, political division like we haven't seen in generations, escalating geopolitical tensions, and rising interest costs. In other words, the 40-year arrangement that allowed America to borrow cheaply while Japan effectively picked up the tab, that's over. It's done. Japan is out of money, out of demographic strength, and frankly, out of illusions. For an entire generation, America lived on borrowed time and borrowed money. And that time is now ending. The transition ahead is going to be turbulent. There's no sugarcoating that. But understanding what's happening, understanding why it's happening, that's the first step in preparing for a world where the easy money era is finished and a much more uncertain financial chapter has already begun. So let me ask you, are you ready for this? Have you thought about how this affects your savings, your investments, your plans for the future? Because this isn't coming someday. This is happening right now. Let me quickly summarize what we've covered today because this is critical. Japan, America's biggest foreign creditor for decades, is pulling back from US debt. They sold $62 billion in treasuries in just one quarter. The yen is collapsing, Japanese bond yields are at multi-decade highs, and the math that made Japan our lender simply doesn't work anymore. This means higher borrowing costs for everyone, from your mortgage to your credit cards to government spending. The carry trade is at risk of unwinding violently. And we're witnessing the end of a 40-year era of cheap American borrowing. The implications are enormous, and they're just beginning to unfold. If this analysis helped clarify what's really going on, please hit that like button, subscribe to the channel, and if you can, become a sponsor. This kind of deep dive work, the fact-checking, the research, connecting all these dots, it doesn't happen by accident. It takes time and it takes resources. Your support makes it possible for me to keep doing this without answering to corporate interests or advertisers. I'm grateful for every single one of you watching. Let me know your thoughts in the comments. I genuinely want to hear how you're thinking about this, and I'll see you in the next one. I have a small but vital favor to ask. If you value a voice that refuses to echo the approved narratives, please take a second to hit that like button and subscribe. It sends a message to the algorithm that you want more of this reality, not the spin. But I also want to extend a deeply personal invitation to you. You see, walking away from the big networks meant leaving behind the safety net. We don't have corporate overlords or massive ad budgets keeping the lights on. It is just us, and it is just you. And I have to be honest with you, doing this job the right way is hard. It is a daily grind. We spend countless hours sifting through the noise, verifying sources, and rigorously fact-checking every single detail to ensure we never serve you the kind of sensationalized fake news that is poisoning the rest of the media landscape. That level of accuracy comes at a cost, so if you believe in this mission, please consider sponsoring the channel. It's not just financial support, it's a handshake that says the truth still matters. It would mean the absolute world to me to have you on my team.